moving on to number 2 in this next video, talking about these challenges to market efficiencies. And before we move on, I wanted to add one final piece to this previous video talking about small caps versus large caps. You're going to notice there are different ways that we sort these bundles. And I've mentioned here we could sort them into categories, the way that they're defined, or you could sort them the way that Fama and French do in their models, and that is defining small caps as whatever stocks they're analyzing. So if it's all New York Stock Exchange stocks, there's about, I want to say 6,000 of them out there right now, then that means they're going to take the lowest 10% and they're going to define large cap as the highest or highest 10% when you stack all the market cap stocks together. Okay. And yeah, we still find the same effect here, even when we sort it in different ways. So now we want to move on to number 2. And this says that we're talking about growth and value stocks. So for number 2, we find that historically, over the long term, value stocks have outperformed growth stocks. And once again, this is after factoring in beta risk. And when we think about, okay, what's a value stock? What's a growth stock? Let's start in general terms, and then we're going to go into the more academic definition of it. And then we can actually use it in our own world to stack our own portfolios. So when we think about value stocks and growth stocks, I want us to think in general about how if you have a company has a profit at the end of the quarter, they have 2 basic ways of distributing those. They can either give it out to their shareholders in the form of a dividend, or they can reinvest it back into their company in order to grow their company. So now you're starting to see, based on some of the dividend policies and what they do, what these companies do with their profits, give you an idea generally of how we can categorize them. So if you have a company like AT&T, who has been providing a constant dividend for a very long time, we're going to look for value. We're going to try to buy that at a lower price. If you have some of these Magnificent Seven stocks who, if you're NVIDIA or Meta, they're not paying a big dividend. They're just plowing it right back into their company in order to drive growth. So that's just on the high level of how you would maybe evaluate or assess these. But we're learning this in a college level course. And I want to show you how this is actually stacked up and how we might be able to get a bit more precise on how we do this. Because even earlier today, I was doing a search on, hey, what are some of the characteristics about growth and value stocks, just to see if I was missing anything. And I read article after article of just really broad and frankly pretty bad definitions on how you would even do it with no tangible way. So I'm going to set this straight here on this video. And what it comes down to, and this is based on the Fama-French model as well, we're going to look at what we know as book to market ratio. And when I look at that, I go, oh man, this is going to be really complicated. It's going to need a lot of stuff going on. And I found out that a lot of this information is already available and we can stack this without too much pain on our part from our time commitment. So book to market ratio. And this really gives us some better insight as to what these value stocks in terms of, I want a good value for my purchases, or I want my investment to grow to the moon. I'm not really worried about dividends. And so this book to market ratio cuts through all of that. And what it does here is we're looking at the book value. So the book value here is basically at the end of the day, if you look at the balance sheet, we are looking at assets minus liabilities. So I don't use Yahoo for much, but I like their Yahoo Finance because they have a nice summary there and the nice financials go right into their any company you have here in the United States, and you can see total assets, total liabilities straight away. And if you don't even want to make that calculation, this is also called sometimes net tangible book or tangible book value. And this will give you a great indication of what their equity is or what they actually have in assets, net assets on the book. And we're going to take that number and we're going to divide it by the market cap. So our market is number of shares times the stock price. Or if you go to Yahoo Finance or any financial source, you can just see, hey, based on yesterday's close, here's the market cap. Or we just know as market capitalization, market cap. And so we just take book divided by market, and we'll come up with this number. And so what Fama-French does here is we are looking for value here. I found, was just randomly looking at Kohl's, the old department store. Yeah. Kohl's, they had a tangible book value of $3,893 on their books. There's their net tangible book value, and their net market value was $2,243,000,000. And it looks like we have a ratio of 1.74, did a little rounding there. 1.74 is the ratio. And so what we're doing is we're going to stack up whatever numbers that we are, or whatever stocks that we are analyzing. And just to go back here to the Fama-French model, Fama-French, they will take, and I'll show you here in just a moment here, but I want to do, that one's actually, you're going to notice anything greater than 1 means, hey, this is a little bit undervalued here, quite a bit undervalued actually. I'm going to show you NVIDIA, and we're recording this here in the beginning of August of 2024. And it's been on the rise. It's pulled back a little bit recently, but I'm going to use the valuation here from the first week of August. And we find that NVIDIA has a net book value of $37,436,000,000. And the market cap on that is $2,505,000,000,000. So I'm going to get this right here. That's billion. This is trillion if we capture that. And we divide this, and once again, make sure you have all of your zeros in order. And if I did it correctly, I have 0.015 as the ratio. So the market cap, or the net value, or the net assets, is 1.5% of the actual market cap. And so you can see here, the lower we go, the higher the growth. This is less value, essentially. And then the higher numbers we get, this is what we would consider better value, because we're going to try to buy it at a lower price and let that increase over time. And so Fama-French, back to that point, the way that they stack their portfolios when they factor this in is they take value stock as the highest 30%, and they define growth stocks as the lowest 30%. And then those middle 40% are just called neutral. But when we take value versus growth in order to determine which one does better, that's how you will rank and compare those two numbers. Now, what you're going to notice though, before we make any broad conclusions and jump straight into value stocks, we have to also understand that this doesn't work all the time. Value stocks historically over the long period of time has outperformed. However, if we look to the last 15 years in our low interest rate environment, it's been all about growth stocks and just chasing it, all that momentum to the moon. And so again, before we start making decisions, we have to realize what kind of environment we are in. And also we're going to have a conversation later about just because it's worked in the past, does it work in the future? But if I'm looking here, we can definitely see where some value can be in particular stocks and perhaps where things can be a bit overvalued. So anyway, that is number two. And if you have any questions, let me know. Otherwise, we'll see you on the next video.